Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to talk about the state of the market. I'm going to talk about the indexes, weekly, daily charts, NASDAQ and S&P 500, and then I'm going to get into some breadth indicators to get a sense of what is going on beneath the surface. All right, let's get into it. All right, first, some index charts. So here's the S&P 500. Going back to early 2000, basically this is getting close to the COVID low. You can see 2000 was a great year after the low. 2001 was a phenomenal year. And then 2022 was pretty weak. There were some bounces along the way, but weak most of the time. And then 2023 has been mostly pretty good. Overall, the net of it is, right now we pretty much have a neutral market because S&P over here at 4,400, which is the same price as here and here and here and here. So we're basically unchanged going back to August 2021. So unchanged over 2 years. And since that time, we had a big move down, big move up. So a lot of times people zoom in really close and get either super excited or super panicky. And the reality is we had a huge move up from the low 2000s. This is not the low. The low is in April, or the low is in March. Basically, we had a huge move up where the market pretty much doubled, and then we just had a big correction and a recovery, and we've had like this big period here that has lasted more than 2 years of essentially just a big fat range. Okay, so if you zoom in really close, again, it's easy to get excited, easy to get really down, but overall we've just had a neutral market, which is a great trading market. For it to like rally and then pull back and then rally again and over time make no upside progress. But in that time, you get a lot of trades to both the long side and short side. That's a great fertile trading environment. Okay, so looking at what we have right now, S&P broke out at 4,200, rallied up to 4,600. It was a perfect measured move because you got this low here at 38. That's 42, measured move 46. Perfect measured move. Now we're backing off. 21-week moving average may be support here. So in the, looking back 6 months, the trend is up. Right now we're pulling back within the uptrend, and we'll see what happens. We could have many candles in here. It could break down, maybe retest 4,200. We could find support here at the 21 and move back to the high. I would consider us to be on the weekly time frame. I would consider this to be fairly neutral. Okay, we moved up, we backed off. Last week we had an inside week. I don't think this is a reason to be overly bullish or overly bearish. I'd say directional momentum right now maybe leans a little bit down, but overall I don't think there's anything hugely wrong with the market on the weekly time frame, and there's also nothing hugely fantastic about it. Looking at the NASDAQ chart, it looks similar, but the moves are more exaggerated. The move down here in 2022 was much worse than the S&P 500, but you can see double bottom moves up. Really nice volume over here as we get out of the double bottom, comes down, tests one more, moves up, consolidates here for several weeks, and then just goes on a phenomenal run in May, June, and July. Lots of great trades. I mean, this was the best trading we've had since 2021. A lot of good trades going for, many, many points. A lot of stocks going 50, 100%. It was truly great trading. And now we've backed off and, again, found support at the 21. Whether it holds or not, we don't know. But on the weekly time frame, to me, it just looks like, hey, we had a nice breakout here over the summer. We've rallied up, and now we've pulled back. And that I consider it, as of now, this is just like a normal pullback within an uptrend and nothing to get overly excited about because this pullback could keep going. It could move sideways for a few more weeks. But it's also nothing to get like overly pessimistic about because the reality is if you look at this entire move over the last 8-9 months, that's actually not bad. Okay, the market's allowed to do some backing and filling, not a reason to panic. Okay, not a reason to hold stocks, but not a reason to panic. So here's the S&P 500 daily. Okay, as you can see, moved up, early parts of the year, backed off, pretty much gave it all back, moved up, consolidated for almost 2 months, broke out in, June and July were phenomenal, and then we backed off, obviously, since then. Zooming in right now, we get the 8 and 20 moving down, with the 8 having moved below the 21. Index moved down, came up, got rejected by the 50-day moving average, and then moved down again. So we got in, per the daily time frame, we have to lean bearish in the near term until the index can get back above the 50 and 21. Okay. But there's nothing that says this can't just go like this. Okay. You don't know. So it's like on the way up, it was easy to be bullish, and on the way down, it was easy to be bearish. Right now, I think we got to lean bearish until the index could get up here on top of the 50-day moving average. It's just the way it is. Okay, here's the 50, if it goes below that and moves up and gets rejected, until it can get above that moving average, we have to lean down and consider the possibility that we're going to like fall into some of the open space over here. Here's the NASDAQ, similar situation. I'm going to get through this a little bit quicker. Consolidation here, February, March, April, rallies up, consolidates, rallies up again, falls fairly hard, fairly consistently, moves up, gets rejected by the 50 and comes back down. So until we can take out the 50, bias is going to lean to the downside. That doesn't mean the market's going to fall apart. Maybe it just needs some more time to restore its energy. Maybe it can consolidate here. I see best case scenarios, it can consolidate here and then it could break out. And of course, worst case is it can actually break down. But at this exact point in time, bearish, our bias has to lean down a little bit until we can take out some moving averages. All right, now let's get into some of the breadth indicators. And this is the ones I'm going to be covering: advanced decline line, advanced decline volume line. So the 80 line lets all stocks talk equally. Okay, it doesn't matter if you're Apple or some small cap stock. Everyone gets to vote one time, and we tally up the votes. Okay, so you could argue that that's not a great indicator, because why should Apple count the same as some small cap stock? That's just the way it is. Advancing volume, declining volume uses volume. So sometimes most of the time the bigger stocks actually have more volume, but there are some smaller stocks that are $1 billion market cap that trade more, that are really cheap. They're like $1, $2, and they trade more volume than Apple. So you can argue that that's not fair either. Neither one is perfect, but when you take the sum and the net of it all, it does paint a little bit of a picture, and it gives you a glimpse of what's going on. Other breadth I'm going to look at is high-low. It's how many stocks are making a high versus how many stocks are making a low. I tend to look at like the 5-day high-low, 20-day, like the 1-month high-low, 3-month. I'm not going to look at all of them in this video, but that's why I'll look at all of them. So if there's 300 stocks making a 5-day high and 200 stocks making a 5-day low, then the net of that is a positive 100. Okay, and then stocks above key moving averages. Okay, it works the same way. How many stocks are above a key moving average? Okay, and then what I'm looking for with breadth is, like, say the market moves up like that, and the number of stocks above their 5-day moving average is like 500. Okay, and then say the market backs off and then it like moves up to another new high. You're either the stocks above their moving average is going to match the previous high, or it's going to put in a lower high to tell you that the participation is low. Okay, so if there's like 500 stocks above a certain moving average here, but there's only 300 here, the market's pressing higher, but there's less stocks participating, and that doesn't mean the market has to crash right there, but it tells you that the market is getting thinner, participation is less, and like negative pressure is building, and the upside is probably limited, and like at that point in time, you want to like pull back on your trade. It doesn't mean you have to go to cash, but it does mean you should like raise stops, keep them tighter, and be less aggressive. All right, so let's get into these. All right, so here is the advanced decline line. Up top is the S&P 500. Down below is the advanced decline line. So divergences work. High prints, low prints are things I'll look at. So, for example, here's a negative divergence where the market was moving up at the advanced decline line, put in a lower high that told you that like less stocks were advancing versus declining. What it tells you is that in this period here, when you have an up day, the advancers will probably beat decliners by a certain amount. But when you have a down day, which there's a down day in there, that means decliners will beat advancers by an even bigger amount. So even though the market, market might go up a bunch and then down and then up a bunch and then down, but if the down days are worse than the up days are good, then the net of that over time is a declining advanced decline line, and that's internal negative pressure that tends to pull the market down eventually. So looking at what we have here is we had a divergence here, as you can see. And then, so for the last, since like the second week of July, the advanced decline line has been trending lower. Advancers do beat decliners sometimes, but decliners have beat the advancers by much more and by a greater amount. So for the market to bounce here, if we get a bounce, we're going to need this to get to a higher level. We're going to need it to come down and put in a higher low. We're going to have to see it go into a higher high. We're going to want to see this trend up. Okay, so even if I were to draw a channel in here, in the same way that this channel down, we're going to want to see this channel up to be some sort of confirmation that advancers are beating decliners, and that buyers are being a little bit more aggressive. If that doesn't happen, then any type of bounce is probably going to get sold into. Okay, so this is going to be it's either going to confirm a bounce or it's going to reject a bounce. And of course, if this just kind of peters around and continues down, then like internal pressure is going to build in the this is the S&P, where it's, even if we bounce, it's going to break down and take that out. So next one is advanced decline volume. Works pretty much the same way. Again, they're not perfect indicators because of the way things are calculated, but they're pretty good over time. And you can see here we moved to a really low level. We stayed there for a couple weeks. In the past, we've had these pin bottoms. Okay, here we stayed here at a low level for an extended time. So this is definitely bearish enough to support a bounce, and we'll see what happens. Okay, if the market wants to bounce here and this continues and this moves up, fantastic. If we struggle to move up and we come back down, then the market's not going to go anywhere. Okay, so we're going to use this, like I can say, first of all, that this is low enough to support a bounce. But then second of all, if the market tries to bounce here, we're going to need to see this move up and confirm that that move. All right, next up is a 5-day high low. How many stocks are making a 5-day high versus number of stocks making a 5-day low? You can see starting like second week of July, this was declining. So even as the market was moving up here, less and less stocks were making 5-day high versus 5-day low. So this is a really good short-term indicator. Obviously, it's not really the market isn't really sensitive to it. You get a divergence here that lasts a couple weeks before it has an effect. But you can see when it does have an effect, it's pretty obvious. You can look at other divergences like right there versus right here, and the market ended up. I mean, this doesn't look like much, but that's like a couple weeks of moving sideways. It happens all the time. It's a great indicator to look at. So what we've had in the near term is we got a pretty good bounce here, right there. So that could be the start. Okay, I'm going to get rid of these lines, easier to read. So that could be a pretty good start there because we got a decent move up, took out that high. So as long as we could hold up here, that'd be great. Okay, an ideal situation is we print a new low here, and then this puts in a higher low, and then we get a lower low there and a higher low there, and that kind of a positive divergence would be a great platform to rally from. Don't know if it's going to happen, but for right now, really short-term indicator is saying that like this print is low enough to support a low, to support a bottom. Like that one was a bottom, that one is a bottom, that one is a bottom. You can match these up. So this was bad, and this right here is bad enough to put in a low. Then we got a nice move. If we get a higher low and this like resists falling, the market should be able to bounce from here. All right, next up, same concept, but we're going to use the 1 month high low, 21. I guess you can call it 20-day or 21-day. It's a 1 month high low. Same type of thing here. Very steady move down here since second week of July. Even as the market was moving up, that was like lots of fair warning that internal pressure was building. I talked about these indicators at Levitt Brothers, so subscribers there kind of knew. They knew that this was happening. I talked about it in a video a couple weeks ago, but this low is certainly bad enough to support a bounce. It certainly tells us that bearishness had grown. We got a little bit of a bounce, but it's not big enough. So we need improvement here. If the market tries to rally here, we're going to need this to rally up. Okay, a little bounce, little move up here, fine. But if this is going to move up for a little bit of time, we're going to want at least to see this get up to zero, and then on any type of pullback, it's going to have to hold its gain, not resist falling too much, and then move up from there. Okay, so sometimes these indicators lead. okay, which is what happened over here when, as the market was pressing higher, we got warning that it wasn't supported. And then sometimes they lag, meaning after the market moves, we're going to want to see the indicator do a certain thing. So we'd have to sit back and wait and see if we get confirmation or if we get rejection. Okay, right now we're kind of in the middle where we don't have anything. We got to wait till something happens. All right, next up. All right, this is the Russell 3000 stocks above their 5-day moving average. So another short-term indicator. Works the same way. How many stocks are above their 5-day indicator? It's really, really simple. You can look at how many is the S&P 500 above its 5, but we can look within an index and say of all the stocks in the Russell 3000, there's almost 3,000. There's not quite 3,000, almost 3,000. Of those 3,000, how many are above their 5-day moving average? So over here there was like more than over here there were more than 80%. Okay, and then even as the S&P 500 moved higher, over here there was only like maybe 67, 68, 69%. So we went from like 80, 84, 85 down to 60 something. So even though the market was moving up, like less and less stocks were participating. It was a definite warning that less and less stocks were coming along for the ride, and that's internal negative pressures building, and eventually that wears on the market. So the market came down, but we got a nice move here. Like that's a low print. You look at the other lows here, this. They match up with a lot of lows from over here. So certainly this is a low enough print to support a bounce. This move here from like whatever that is, like 10, 11, 12%, all the way up to 60% is a great move. So whatever the market does here, we're going to want to see this indicator hold up, put in a higher low, resist falling back down, give us some indication that like stocks are not completely falling apart, that there actually are some stocks that are holding this short-term moving average. And then that'll be a good sign that the market is starting to form a foundation and can rally from there. Okay, so we're in wait and see mode. Okay, this is a really nice bounce off the low. Now it needs to continue for us to feel confident that like we're actually going to get a tradable rally. All right, last one here. This is Russell 3000 stocks above their 20-day moving average. Works the same. Market pressing higher here. Less and less stocks above their moving average. At first, it's not a big deal. Yes, you get an 80% print here, and then you get a 70% print there. That's salvageable. That doesn't mean the market has to crash. But when you come over here and you get a lower low and it drops below 60%, then you're starting to get into territory where it's like, okay, this divergence is actually going to play out here. So obviously it's been declining for a while. We're down to 20% here. That's the lowest level since way back in March. This has also lasted long enough to support a bounce. You can see here, like this was a big pullback, and this was a big pullback. We based for a couple weeks, and then obviously we got this huge rally. The S&P 500 went from under 4,000 up to 45, 4,600. So we have another repeat of that where we had like the number down here has been pinned at 20% for a little bit. Maybe it needs to continue, maybe it doesn't, but like you probably know the routine by now. If this is going to move up, if we get a rally attempt in the next week, we're going to want to see this move up just like we saw it over here. If this resists moving up, which is telling us that stocks are not getting above their 20-day moving average, obviously that's telling us that we're just not getting a lot of participation. The market is weaker, is pretty weak, and it's just not in the cards right now to move up. But if we get expansion here, that'll be a decent foundation to actually attempt a bounce in. Okay, so overall, I'd say market overall is in good shape. It's been in horrible shape this month. Breadth has fallen to levels that have only been seen a couple times this year. Breadth is at levels that could support a bounce. Some of the indicators improved last week. I think right now it would not be wise to have a strong opinion. Okay, day to day, anything can happen. This is not a time where you could be confident that the market is definitely going to go up or definitely going to go down. Market's going to move. Breadth is either going to support or reject the move. Mental flexibility needed right now because I just don't think the path forward is clear. Some of you might not be happy that I'm not going to sit here and tell you what's going to happen, but if you're not sure what's going to happen, that in and of itself is an indicator. Okay, trading's one of those activities where sometimes it's easy, sometimes it's hard. And the key to trading is when it's easy, make as much as you can. And when it's hard, it's okay to just say, hey, trading is hard right now. I'm not sure what's going to go on. And don't push it. Okay. Don't lose money. It'll get better. And right now is one of those times where the path forward is not really clear. And that's okay. You could tone things down, have a lot of cash, and wait till things get a little bit easier. Wait till you get clearer signs. All right. Hope you got something out of this. We'll see you next time.